in July of 2020, I wrote an article in the middle of COVID making the case that what was likely to happen was we were going to have all of this pent up demand get moved forward and have a giant housing boom. In this article, I said it was a tough time because it was COVID-19 and all the lockdowns, but at the same time, it was a once in a lifetime real estate opportunity. And I actually quoted an economist that said the housing market led us into the greatest recession of 2009 and will most likely lead the charge into the recovery from this pandemic. And boy, was I right. Just fast forward another 6 months to a year from there, and the housing market went crazy. And in hindsight, we all wish we would have bought like 10 houses during that time. But what actually happened was exactly what we talked about, which is people started waiting for the market to get more confidence to be able to buy, and then everybody jumped in the market at the same time. Fast forward to today, and over the last couple of years, I've heard so many people say that, you know what, we are going to wait to buy a home. Not because they didn't qualify, not because they didn't want to own a home. It was just because they wanted a lower payment, which I certainly understand. And we are going to look at this really interesting article and chart that shows what's likely to happen in 2025. And I think you may be shocked as far as appreciation goes. And I believe we are seeing something similar where a lot of people are waiting for something, and then as rates fall, which they're likely to do next year, it pushes all that demand in the market and it makes it much more competitive to buy. So we are going to look at that, and we are going to look at rates, which seem to be finally heading in the right direction. Hey everyone, this is Rayce Robinson, your favorite Florida mortgage broker, and wow, we are finally getting some movement on rates in the right direction. A lot of that's because the job reports came out. Unemployment clicked up a little from 4.1 to 4.2, but when you look at the job creation data and you look underneath the hood, I believe, and so does the bond market, that you're starting to see some weakness, and that's starting to get priced in. What that ultimately means is lower rates. So when we look at the 30-year fixed rate mortgage, just as a trend, this is Mortgage News Daily. Everyone's rate's different, but I like to use the same scale to measure the direction of the market. So when we look here, they are saying right now, look at this big drop, really for almost the last 11, 12 days, now under 6.75%, getting closer and closer to the 6.5%. And when you look at this chart, which I think is a easier way to see this as money back going in and out of mortgage-backed securities, you can see this run as this is getting higher, rates are getting better, that has been going on here for the last 10, 11, 12 days. Why is that? It's simple, because the Fed has a dual mandate. They're looking at inflation. We get the CPI report next week, but they're also looking at unemployment. And if the unemployment data is weaker than what it looks like, then that's going to be incentive for them to start cutting rates. And what does the market think? Well, right here, you can see this not too long ago was a 60% chance that the Fed would cut rates here on December 18th. And now it's 88.8%, which I've been saying for a while that if unemployment gets worse, and right now it just went from 4.1 to 4.2, that will make rates lower than what people are thinking. And a lot of people have, including the Fed, including the markets, have scaled back the cuts that the Fed is likely to do from really a couple hundred basis points and now only thinking they're going to do 0.75 or less than 100 basis points. We shall see. No one knows. But I personally think the rates will be a little bit lower than what people think. And what does that mean? What's the opportunity? Well, I've looked at the loans that we're currently working on right now. We have an FHA loan that we're closing with $10,000 closing costs. We use that to buy the rate to close to 6%. We have a VA loan where closing costs are being paid at $10,000. We have a seller doing a 2-1 buy down for our buyer that's costing the seller almost $13,900. And on top of that, we have a couple conventional loans where sellers are paying closing costs. And we even have one where the seller is replacing the roof for the buyer. If you do that math, that is $60,000 to $70,000 in concessions that these buyers are getting. If rates were 0.5% lower, they would be saving about $130 a month on a $400,000 mortgage. And you can see that all this pent up demand, meaning people that are waiting, all of a sudden we get that $130 a month lower payment. The news starts saying it's a great time to buy a home. What happens? They start coming into the market. And all of those concessions that our buyers, as people in the real estate and mortgage industry, are getting will slowly start disappearing. So that is the opportunity we need to be teaching our clients, because we don't know what's going to happen with interest rates. but we do know that sellers are more flexible than they've been. The real question that we really have to educate our clients and people is, what they're really waiting for or hoping for is some kind of big market correction. And the data just does not support that. So sometimes I get some hate when I say that the market is not going to correct or crash. And that doesn't mean that it won't correct or crash. It just means that we have to get enough inventory for the market to do that. And so I like to look at not what I think, but what other people think. And so this was an interesting article about what to expect from U.S. home prices in 2025 as predicted by 16 different forecast models. And when we look at these 16 models, I think it's really interesting. We have anywhere from 10.8% all the way down to one person, Moody's, who's always very conservative, predicting really a flat market. And what they're noticing is a recent finding by Freddie Mac talking about there's still a supply shortage across the nation when you look at household formations and housing stock and likely demand going forward, and that puts upward pressure on homes. And the way I like to look at it is when I'm talking to a client, what that really means is as that happens, those incentives that I just went over, all those big savings and cash to close or using to buy the rate down, slowly start disappearing as the market appreciates and more buyers jump in the market. So we want to keep tracking this, educating our buyers that right now is probably when people are going to look back and say, man, I wish I would have got pre-approved, had someone explain the numbers in the market to me correctly, and went out and bought a home. Now, that's not to say that every market is the same, that every market is experiencing the same appreciation. So we want to understand that all markets are local. This was a really interesting map about 3 interactive maps that show where the resale housing market has weakened and where it remains tight. And you can see this tracks the sales to list price ratio, and anything above a 1, meaning it's sold over list price, and anything below 1, minutes sold under list price. And this is kind of showing you the spots around the nation. And it is no surprise with the buildup in Florida that we are a place that has a lower sales to list price ratio. But when you really dig in and take out some key markets like Cape Coral and other ones and go look here in Orlando and Central Florida, we are here still at a 0.98 sales to list price ratio in September. And then here's a chart of the 200 largest metro area housing markets. These 10 markets have the highest sales to list price ratio. From Rochester, New York, and 1, 2, 3, 4 properties in New York, a couple in California, New York, New Jersey. And then we also, when we look at the lowest or worst sale to list price ratio, we have a lot in Florida. Naples, Cape Coral, Punta Gorda, Gainesville. But even these ones that are really bad is 0.95, meaning there's still a 95% sales to list price ratio, meaning that it is not this absolute buyer's market that some people would start to believe. It is definitely more balanced. Inventory is kind of flattened out, but I do think as rates fall, we are going to see that sales to list price ratio slowly creep up, and the opportunity for first-time home buyers when you look right now with bond programs and down payment assistance and all these different things and incentives that are out there right now for buyers. Again, my opinion, we shall see. I wrote that article back in COVID. I'm saying right now, I think people will look back and say January, February, March of 2025 would have been a great time to jump in the market. If you've been thinking, you know what? I wonder what the payments would look like right now. Reach out to me. Rates have started to drop a little bit. And if you're a real estate agent looking for somebody that does have all these programs and understands how to work with buyers, get them through the process and get them ready to buy, reach out to me. I'd love to help. Anyways, that's the data for this week or the news for this week. If you have any questions, reach out. This is Rayce Robinson, your favorite Florida mortgage broker. Have a great day, great week, and I'll talk to you soon.